Profitability refers to the financial performance of the business. Accounting ratios that measure profitability are known as profitability ratios. Profitability ratios are divided into two categories: margin ratios and return ratios. Margin ratios determine the profitability of the company at different levels of cost. This includes gross margin, operating margin, pre-tax margin and net profit margin. Gross profit ratio establishes the relationship between gross profit and revenue from operations, i.e. net sales of an enterprise. To arrive at operating profit margin, you first need to calculate operating profit. Operating profit is determined by subtracting operating costs such as selling, general and administrative expenses from the gross profit. Then operating profit margin is calculated by dividing operating profit with revenue. In order to calculate pre-tax profit margin, you first need to determine pre-tax income or earning before tax, ET. Thus, pre-tax profit margin is the ratio of pre-tax income to revenue. Net profit margin refers to the percentage of profit a company generates from its revenues. In other words, this ratio indicates the amount of net profit a company is able to generate for every unit of increase in revenue. Return ratios indicate the ability of a company to produce returns for its shareholders. The commonly used return ratios include return on assets, equity, total capital. Return on assets, as the name suggests, indicates return generated by a company on its assets. A high return on assets ratio indicates that the company is able to generate more income from the given amount of assets. ROE is calculated by dividing a company's net income by its total assets. Return on equity, ROE, is a measure of financial performance calculated by dividing net income by shareholders' equity. Return on total capital, ROTC, is a return on investment ratio that quantifies how much return a company has generated through the use of its capital structure. Earnings before interest and taxes, EBIT, represents profit that the business has realized, without consideration of interest or tax payments. Total capital refers to the business's total available capital, calculated as short-term debt plus long-term debt plus shareholders' equity.